The Bogleheads Guide to Investing, forwarded by John C. Bogle. We will talk about the steps to investing and what you will need to know just to get started. 3 steps before you start investing. Number 1, graduate from the paycheck mentality to the net worth mentality. Net worth is the total dollar amount of the assets you own minus the sum of your debts. Income is how much you earn in a period of time. If you earn $1 million in a year but spend it all, then you're just living lavishly and not following the net worth mentality. Your net worth depends on your spending habits. Number 2, pay off credit card and high interest debts. This is pretty straightforward. Paying off credit card debt and any high interest debts will free up money to be invested and profited instead of revolving high interest rates, decreasing your net worth. Number 3, establish an emergency fund. The magical amount is really based on the individual, but I did find it interesting that they suggest that if you are in a stable job, that 3 months of pay and the savings would be just fine. He suggests putting this emergency fund in liquid accounts such as a savings or money market account. Start early and invest regularly. They stress the importance of investing early. As you can see in this graph, it illustrates the importance of starting early. Eric at age 25 starts contributing $4,000 a year in a Roth IRA and stops contributing after 10 years. Larry, on the other hand, at age 35, starts contributing $4,000 per year to the Roth IRA for 30 years. Assuming there's an average 8% annual return, Eric's total at 65 is $629,741, and Larry's total at age 65 is $489,383. So Eric contributed 20 less years and $80,000 less dollars, but he started 10 years earlier, allowing his total to be roughly $150,000 more than Larry. Because of compound interest, Larry comes out under par. The magic is in the compounding. You may not think you make enough money to become a millionaire, but the truth is that the magic's in the compounding. The rule of 72 is what the authors give for a good estimate. At any given investment time, you can divide 72 by the annual rate of return. In the example on the slide, the rate of return is 8%, and divide 72 by 8 and it will take 9 years to double your investment. This may seem like a long time, but the thing to remember is that it's a compounding investment. So every time it doubles, it becomes 4, and then 8, and then 16 times your initial investment. They give an example that $601 invested at the beginning of the month in stock index funds, coupled with an average return of 10%, grows to the sum of $1,249,655 in 30 years. Just in case you're wondering, $601 is 28.9% of a yearly salary of only $25,000. So the excuse of not making enough money to invest to be a millionaire becomes no excuse at all. They urge to keep it simple, but to start early and take advantage of compound interest. The authors stress knowing what you buy, and they write the majority of their tips regarding bonds and mutual funds. They suggest holding a percentage of your age in bonds. So if you're 25, then 25% of your portfolio should be in bonds. So the older you get, the less risky and more bond percentage you'll hold. If you are a more conservative investor, then you'll want to hold more bonds than more risky investments. To the authors, the best way to invest is through mutual funds. They describe a lot of details regarding mutual funds, and here are their list of advantages. Diversification. Mutual funds provide an instant diversification with stocks and bonds. Mutual funds have professional managers and low minimums. And many mutual funds offer products with no sales commissions, and you can buy them directly from the mutual fund company, bypassing a broker. They have liquidity, automatic reinvestment, and convenience. If you have a question or a problem, you're able to call your mutual fund's customer service line and speak to someone directly. You receive statement communication at the end of the year. The variety of mutual funds out there allows for a pretty perfect fit to any investment need. The authors go on to tell about mistakes they've made in investing, and at the end of all their mistakes, they came to the conclusion that low-cost mutual funds should be the primary investment choice for most investors. So, how much do we need to save? How much do you need to save? This is a big question that most of us ask. I love this quote in the book. You really don't need to begin saving for retirement before you reach 60. At that point, simply save 250% of your income each year and you'll be able to retire comfortably at age 70. Crazy thought that if we wait too late, we won't have what we need. They provide many calculations to arrive at the estimated number, but that number depends on so many aspects of life. For example, what age you want to retire, how many years you'll be in retirement, determining whether you want to leave an estate, estimating future returns, inflation, inheritance, and other income. All of these things affect the amount we need to save. So they say the more you save, the better off you are. And for people around my age, they estimate someone who wants to retire in 30 years, they need to accumulate approximately $1,193,460. So now that we have that basis, we get to asset allocation. Asset allocation, the two most important words in a portfolio decision making. You have to know what investments to select and what percentage you'll allocate to each investment. The saying, don't put all your eggs in one basket. Make sure you diversify your investments. There's no market guarantee and no one can truly predict the market change. So diversify to cover any losses that may occur. The young investor's asset allocation. Here's an example of a suggested asset allocation for a young investor. 55% should be to large cap stocks, 25% should be in domestic mid-small cap stocks, and 20% should be intermediate term bonds. These suggested percentages change with age and change when you move closer to retirement. Do you need an advisor? After talking with asset allocation, you begin to think about, do you need someone to help you? Do you need someone to tell you where to allocate your assets? For the most part, the authors encourage against advisors unless properly accredited. I could not believe that all it takes is a business card to be a financial analyst, financial consultant, financial planner, or investment consultant. So it's important who we trust in charge of our investments, so beware. Then we get to our next step, investing for college. Economists report that a college education adds many thousands of dollars to a man's lifetime income, which he then spends sending his son to college. According to the Bureau of Labor Statistics, U.S. Census Bureau figures show that a college graduate with a bachelor's degree can expect to earn nearly $1 million more than a high school graduate, and those with a master's degree can expect to make more than twice as much as a high school graduate. So the importance of college saving is great. There are so many options for college savings. Because there is no one plan that works for everyone, the authors suggest reading publications based solely on the subject of college savings plans. So if you choose any of the options listed when your children are getting close to graduation, you won't be panicked, but you'll be prepared. While on the subject of kids, we talk about being properly insured. They also talk about the importance of being insured for your family's sake. And the 3 keys to properly being insured is only insure against the big disasters that you can't afford to pay out of pocket. Carry the largest deductibles to keep premiums low. And only buy coverage from the best rated insurance companies. They need to be dependable when you file a claim. So in conclusion, make sure you begin your financial portfolio early to take advantage of compounding interest. Select low-cost mutual funds to be the core of your investment portfolio. Keep it simple. It doesn't have to be complicated. And be sure to stay the course. There will be distractions along the way to make you rethink your investment route. But if you're aware of them and stay the course, you will then be on your way to being named a Boglehead.